Do you think that, I mean, Powell called the move on quantitative tightening a common sense sort of thing. Do you think that was using the balance sheet as a tool more so than actual, monetary policy, cutting interest rates? They still do have the tool of the balance sheet, that they can use it, they are using it, and the reason they are willing to use it now is for some of the reasons that you just mentioned, mindful of the credit markets. He talked about some tightness in money markets, but that's where he really stopped.
Yeah, I mean, the quantitative tightening is effectively zero at this point, which means we might be setting the stage for quantitative easing. I think that he let it slip a couple of press conferences ago that he wanted to get the balance sheet down so that they'd be in a position to have the potential to grow it back up again should an economic need take place for that to happen. So he's got a couple of things going on here. He's getting close to quantitative easing, and in spite of upgrading his inflation dots, he still has two cuts in the market. So I think he was really trying to balance everything out, understandably, because of the tremendous uncertainty. I do notice that the U.S. has stopped outperforming since the Fed started cutting interest rates. Europe is outperforming, and even emerging market stocks have started outperforming. And I think that that's sensible given this reindustrialization concept in Europe. One of the things that might be an unintended consequence of all of Trump's rhetoric is, he's making people think about how much can they rely on the United States for their weapons, for their defense, for their cooperation. And that's probably going to continue to make Europe very, very bullish versus the S&P 500, which has been my concept for a couple of years now. And it didn't really work or not work, but all of a sudden, on a year-to-date basis, Europe is doing really well. And emerging markets are doing pretty well, too. So I think the time is here for, I did a webcast last week or 2 weeks ago maybe, called Not in My Neighborhood, which was a shorthand for it's probably time to pull the trigger for real on dollar-based investors diversifying away from simply United States investing. And I think that's going to be a long-term trend.
And interesting. And it's interesting to me, too, that you really focus on the word inertia, because I wrote it down to ask you specifically about it, where the Fed chair said, and I'll quote the full sentence, there's a level of inertia where you just say, maybe I'll stay where I am, where he's talking about we need to just sit and watch because we're not exactly sure what's going to happen. My question to you, though, is there a danger that they wait too long and the economy starts to deteriorate faster and they're too late to act yet again?
Yeah, I mean, I think that's the risk. He's trying to balance this tension between their dual mandate. I mean, the inflation rate is acknowledged to be going up, so they're not making progress towards the 2%. And yet, the unemployment rate, while low, it seems to be incrementally moving higher, and the deportations may have disruptive effects on the employment market as well. So he's in a difficult situation because he has to balance all of these cross currents. And I think that's why the reporters got so antagonistic. They're sort of saying, you're saying on the one hand, on the other hand, you're going to need another hand for all this. And Jay Powell, I mean, I give him credit. It was a tough press conference for him, and he made it through. And I think he's calmed the markets down pretty well because this is one of the few meetings where we don't have some sort of violent reactions. In this one, it was actually pretty favorable from the stock market. Go ahead.
I'm surprised that we've gone this far into our interview and neither one of us have used the word transitory yet, like he did yesterday, which was a surprise to many people.
Yeah,
you included?
That was a weird one. Yeah, I thought that was a bad place to go. But I think one of the reporters kind of almost meanly goading him into it. He said, well, last time you said that, last time, and Jay was obviously rattled by that because he said, well, if you meant last time that the tariffs came, he didn't want to go right to the one that was from 2021, 2022. But saying transitory on the tariffs, I mean, that's a little bit dangerous because we don't even know what the tariffs look like. But he's trying to thread the needle. And I thought he did just about as well as he could, and the term inertia, I think, reinforces that. He's basically saying no move's better than a bad move. I think they're going to be their philosophy for the next meeting as well. I don't believe we're going to see a cut at the next meeting.
When do you think we get the first one?
I think it might be in June, July type of time frame is when the first cut will come.